Imagine scrolling through your social media, being bombarded by perfectly curated lives, latest gadgets, exotic vacations, and seemingly effortless success. You see your friend, let's call him Rahul, he who graduated with you and who must be earning only as much as you, he has just come back from his trip to Bali and he has posted a video of it on Instagram. You recall that only a few months back he had posted an unboxing video of an iPhone. You wonder how is it that he's able to afford that lifestyle? How come you are not able to? You ask yourself, am I falling behind? But let's take a step back and ask ourselves, do whatever we see on social media, is that the real picture? Let's look at it from Rahul's perspective. So Rahul is a 24-year-old. He graduated about a year ago and he's loving his job. He's earning about 80,000 a month and he has apportioned his finances very well. He's allocated 40,000 rupees for his needs like food, rent, another 24,000 rupees for his wants like shopping, dining out, and 16,000 rupees he's saving for a rainy day. A perfect 50, 30, 20 plan. Uh, yes. So he's really happy. But then what happens is that the evenings with his friends, the social media posts, become showcases of the latest trends. He feels the fear of missing out. He has the pressure of coping up. He recalls that during his college days, he had this wish, a dream of having an iPhone. A year into his job, he's still not able to buy that because the 50, 30, 20 plan is stopping him from it. His dream starts haunting him. And at that moment, his inner voice whispers to him, you deserve it too. At that moment, a savior emerged, a no-cost EMI. With a small monthly payment of 20,000 rupees for 6 months, he had dream of his phone with him, without a wait. He told himself, it's only a small payment, that too without a burden of interest. He went ahead and made that purchase. So that purchase ate into his savings and also replaced a bit of his wants. Now, that small spend, that small EMI became a routine. He got used to it. Everything that it did, he started using it by financing it through EMI. He swiped his credit card left, right, and center. His friends, he had to cope up with them. Whatever they do, he had to do it too. He traveled the world. He went to Bali and everywhere. Everything was financed using travel now, pay later. He was truly living a YOLO life. By the end of the year, he was totally in debt. Everything using EMIs, everything with credit card. All his credit card debt were all-time high, and he was almost about to default. He was now making minimum amount due payments. But he told himself, this is only temporary. I'll tide over this. But at that moment, what happened is that he got a call. He got a call from his mom. His father was really ill, and his father needed immediate medical attention. But Rahul had exhausted all his savings, and all the easy sources of credit were not available to him now. His default history made sure that he doesn't get any cheap source of credit. He searched relentlessly and finally found something, but there was an exorbitant interest rate. He had no option. He took it. That debt saved his father, but Rahul, he was crushed by the sheer weight of the debt and interest which came with it. Soon, the interest that he was paying was much more than the principal itself. Like how Rahul is a common name across Indian households, unfortunately, the story of rising personal debt is not uncommon. A lot of people like Rahul are now saving less and borrowing more. As per recent data by RBI, the increase in net financial assets of Indian households, that is, the difference between savings and borrowings made, has reached a multi-decadal low of 5.1% of GDP. People are borrowing as if there is no tomorrow. The personal loan growth in the last 1-2 years has been 25% per year. That's much more than the overall credit growth of the banking industry of 18%. A CIBIL report says that of 52% of people aged 25 and below had taken 3 or more loans from fintech during October 22 to March 23 last year. That's compared to just 21% 4 years ago. So yes, there are a lot of people like Rahul who are now trapped in this EMI cycle. But what is causing this EMI epidemic? Let's break it down. First is the instant gratification trap. So our minds are wired for rewards. When we engage in pleasurable activities, say shopping or travel, some chemical reaction goes in our head and we feel a sense of satisfaction. Now we want that satisfaction again. We again keep doing that activity, even if it's on debt. Our minds also suffer from something called as the present bias. We tend to overvalue smaller rewards of today as compared to larger rewards of say tomorrow or a year later. So a trip to Bali on a loan would seem more appealing than saving up and going on a world tour next year. Then there's a knowledge gap. See, finances and interests do not come easy to people. It's just not very intuitive. Say you wanted to buy a earphone, it costs 2000 rupees. You go online, you have two options. You can buy upfront, pay the whole amount, or you can take it on EMI. A 3-month EMI at 24% interest would cost you only 80 rupees of interest cost. It's a very small amount. So you take that luxury and you make that EMI payment. But then what happens is that when you start financing your lifestyle spends and your daily expenses using EMIs, it becomes a habit. More and more you do it, you are pulled away from your means. You start living on advance salary. You want to maintain the lifestyle. So one debt gets over, you take another debt, and that piles up. By the end of the year, you'll probably have 1 lakh rupees in debt. Probably 5 gadgets, a travel, some dining bills, all that would add up to 24,000 rupees interest cost, still at 24% per annum. Now, that 24,000 doesn't become very apparent when you make small purchases. That 80 rupees seems very small, so you don't mind doing that. And then when you have this instant gratification trap and when you don't understand the science and psychology of debt, you become a victim of the easy finance options given by the banking companies today. Well, do you know what is the most impactful innovation for consumers in the recent time? Something what person like Rahul would use often. 30 minutes pizza delivery, 10 minutes grocery delivery. Well, I think it is 60 seconds loan delivery. So the thing is that we are being offered with instant loans left, right, and center. Marketplaces like Flipkart and Amazon are giving us embedded finance options. It's very easy to take credit now. No cost EMIs and credit cards are being sold to us like vada pavs on the digital streets. But what on earth do banks earn by giving us a no cost EMI or a 45-day interest-free credit period? Well, they don't earn anything at all. But at the moment, what they're doing is slowly and steadily feeding you with debt. They're patiently waiting. They're waiting and they're pulling you more and more away from your means. And before you know it, you're just too used to it. And that time, you don't mind coughing out interest for that luxury of delayed payment. And that's when you get fallen in traps. Remember that when something is given to you for free, you are the product. And then, despite all the debt, despite all the EMIs, if you thought everything was sorted, at that time, life throws you curveballs. Medical emergencies, job losses, unexpected expenses, they all come rushing to you. And if you don't have an emergency fund, you will be put further and further in debt. And the added burden of interest will make it more terrible for you. A perfect financial disaster. A person like Rahul would find it difficult to come out of it. But it is still not the end of the story. Rahul can still claim back and regain his life. He can do some small, impactful steps and make life work for him again. What can he do? What can we do? First, Rahul and we need to understand that not all desires are created equal. Take out a pen and paper and write down. Differentiate between your essential needs like food and rent and the fleeting wants like latest gadgets. Understand that you need not experience everything that your friends or your influencers are experiencing or holding. You don't need them at all probably. So if you want something, probably write it down. Let dust settle over it. Come back to it a week or two later. And then ask yourself another question. Whether do I really want it? And probably the answer would be a big fat no. Write them down and start saving for them. Or for save now, buy later, rather than buy now, pay later. Every rupee saved empowers you. Every impulsive purchase weakens you. Opt for delayed gratification over instant gratification. Next, write down all your debts. Make a balance sheet of sorts. If you have one or two debt, make increased EMI payments. The faster you repay your debt, lesser interest you have. So, for example, say you have a 7-year vehicle loan, which most of you will be having 3-4 years down the line. There's a simple trick of saving a lot of interest cost. Just increase your EMI payments by 10% every year. That will help you reduce your tenure of loan by 22 months and also save you 20% interest cost. And then, but if you are a person like Rahul, who has a lot more debt and who probably also in default, pay off the smaller debt first. Get them off your checklist. Once you see debt going off your checklist, you can motivate it, you get inspired, and then you probably will start repaying other debt also. You know who is the best credit card customer for a bank? It's a person like Rahul, who defaults, who makes minimum payment, and who also rotates his debt again and again. Don't be Rahul. Banks earn exorbitant interest, late payment fees, and penal charges from them. Having done so much and having come so far, don't let emergencies derail your financial journey. Ensure your future. I would recommend each and every one of you to save at least 20% of your income towards a rainy day fund. Then, get a term insurance. Term insurance of at least 10 times your annual pay. Health insurance also. Health insurance for yourself and your parents. A health insurance for 3 of you for 5 lakh rupees, and a term insurance would cost you roughly only about 3% of your income. Account for these expenses as your necessities. They are very important. Now, having heard me so far, you might be thinking that loan is very bad, never ever take a loan. No, that's not the case. Not all loans are bad. So understand the difference between a good debt and a bad debt. Loans taken for a travel, for buying new gadgets, they don't create any income generating financial assets. That's a bad debt. On the other hand, loans which increase your future income potential, education loan, a business loan, that can be good debt if used well. And no, loans taken for speculative activities, they are not good debts, they're bad. They're probably very, very bad. So understand the difference between the two. See, loans and debts, they're a double-edged sword. If used well, they can be a weapon for your success. But if not, they can cause self-inflicted harm. Breaking free from the cycle of debt can be challenging and daunting, but the rewards on the other side are very immense. Frugality during the initial years of your career can help you lay strong foundations for your financial success. Make sure you follow the right path. You follow the steps I've told you. And if you are not a Rahul, make sure you never become one. And if you are a Rahul, now you know how to get out of that trap, reclaim your destiny, and make it a financially sound one. Thank you. All views expressed are personal.